Welcome to this video. Today we talk about trade finance solution sets as a part of our Introduction to Trade Finance Guide to International Business series of videos. Trade finance plays a crucial role in facilitating international trade. There are various financial instruments, the tools and techniques that are necessary to mitigate the risk in international trade, which are provided by various financial institutions. These ensure smooth transaction between the buyer and seller. This overview looks at the various solution sets, the challenges, the mitigation strategies, scenarios, and use cases. Traditional trade finance solutions can be broadly categorized into settlement or risk mitigation ones. These instruments, which are driven by settlement or risk mitigation purpose, provide payment assurance, and they are the trigger points for payment, and those will be against satisfying settlement and risk mitigation needs. One of the example is the letter of credit. These are widely used instruments providing security for both the buyers and the sellers. If a Chinese exporter is selling machinery to a Brazilian importer, then the Brazilian importer's bank will open the LC and the Chinese exporter's bank will advise the LC. The most important challenge in an LC is the complex document requirements and potential for discrepancies. The only mitigate is careful review of the LC terms and producing documents that comply with the needs of the LC. Next instrument, which is considered as a settlement risk mitigation instrument, is the bank guarantee. They provide assurance that the contractual obligations of the parties are met. If a German construction company is bidding for a project in, say, UAE, then they will have to provide a bid bond, which assures the project owner that if the bidding company is awarded the bid and if they don't take up, the project owner will be able to claim under the bid bond. The challenge is there is a potential for wrongful calls or contractual disputes, and it is difficult to do a cross-border enforcement. The only way to overcome this could be clear and precise drafting of the guaranteed terms and the due diligence about the parties before we enter into the contract. Next comes the documentary corrections as a settlement and risk mitigation measure. Here the bank acts as an intermediary and exchanging documents for the payment. Suppose a Canadian exporter is shipping goods to a Mexican importer. Then the documents will be released against payment by the Mexican importer or acceptance to pay on a specific date. The challenge is that the exporter has a limited protection in case the importer fails to make the payment. There could also be delays. The only way to mitigate is a careful selection of the trading partner, their payment history or a settlement history, and then clear and clarity in the terms and conditions of the agreement. Then there are finance driven instruments, the instruments which primarily satisfy the need for finance. The companies who need finance will choose these, and this also support the risk mitigation requirement. Most important example is the supply chain finance, because the SCF program enables buyers to extend the payment term. Instead of 30 days, they can make it 90 days, while assuring the supplier that the supplier will receive early payment or due date payments through a third party stepping in and financing. Suppose there is a large retailer and they implement a supply chain finance program, then all their suppliers will be able to receive early payment on invoices, and this will be against a small discount. The retailer benefits from extended payment term. The challenge is onboarding the counterparties onto the platform and balance the needs of the buyers and sellers. The mitigation is use of technology and offering flexible financing options and choice. Then comes the receivable finance, another form of ACF, where factoring, forfeiting, invoice discounting are the various flavors of receivable finance, and the companies are allowed to convert their receivables into immediate cash. The challenge is impact on the relationship, and the cost of financing. And the way forward is to evaluate the financing cost against the benefits that it offers by availing factoring, forfeiting, or a receivable finance or an invoice discount. What are the emerging solutions? As technology advances and there are needs in the market, the demands and supply causes evolution of the methods and techniques. There are new solutions in the market which address specific challenges and provides some opportunities. One example is blockchain, where it offers faster, transparent, and secure financing opportunity. For example, a consortium of banks and technology providers together had developed a trade finance platform that reduces the processing time and enhances the security of the working capital. Voltron, Marco Polo, etc. are the examples. The challenge is regulatory uncertainty because in many regulations it is still not clear how or what can be done with the blockchain technology. Another problem is integration with the legacy systems. Then comes the AI and machine learning, AI and LLM or ML. Here, the new technology is having potential to be applied to enhance the risk assessment of the parties or detection of frauds on the transactions and thereby optimize the working capital by understanding when and what is required. Data quality is a challenge. Availability of a model is a challenge. Trained manpower is a challenge. Investment funds is a challenge. Explainability of the AI decisions is a bigger challenge. The mitigation is nothing but education, training, and spreading of information as to how the models work. That is why we need interpretable or explainable models. Then comes the Internet of Things. This is integration of internet into the devices so that we know where the goods are moving, what's the condition of the goods. Is the container continuing to be in the cold chain at the right temperature at the right place, etc. So we can have smart sensors installed which will help in tracking and triggering automated responses. The challenge is the data security or privacy and the need for standardization. Robust cybersecurity measures is a requirement. Collaboration with the various partners in the industry is a requirement to make good use of AI and ML or IoT. Then comes the sustainability. In sustainability, we are looking at environmental, social, and governance requirements, the ESG factors. The UN Sustainable Development Goals provides certain incentives for trade finance which are more sustainable. For example, a global bank launches a supply chain finance program that offers concessional rates of interest for suppliers who meet certain sustainability criteria, thereby incentivizing sustainable practices in the physical supply chain. So, defining or measuring sustainability is a challenge. Ensuring integrity of the data is another challenge because anybody can claim I am sustainable and please give me concessional interest. Alternative trade finance providers are also there in the market because the fintechs are the alternative lenders. Then comes the peer-to-peer lending platform who provide working capital. The challenge is the diluted regulatory requirement in certain jurisdictions, which erodes trust or credibility of the provider in the market. Then there are solutions which are aimed at specific industries. For example, certain industries have certain unique requirements, and so the solution need to be tailored to their demands. One example is the commodity trade finance. What is commodity trade finance? It is a specialized type of tools, techniques, or solutions offered to traders who are dealing in commodities, which can be oil, metal, or agro products. Now, the most important challenge in commodity finance is the volatility in the prices. Next comes the complexity in the logistics or storage of the commodity. So, partnership with the various stakeholders is the only way to mitigate this risk. Then comes the project finance. Project finance is nothing but long-term financing for large-scale projects. So, these are mostly sitting above industries type and these are mostly for capital goods. The risk is the long tenor of the transaction and complexity of the risk because of the multiple um, stakeholders involved in a large project. Use of export credit agency to support and mitigate the political risk is an important aspect of project and export finance. What are the challenges in trade finance? The most important challenge is the compliance with regulatory requirements, because in spite of the variety of solutions that are available and the technology that is available, the landscape of compliance is evolving every day and it differs in different jurisdictions. So there is a need to invest in robust compliance management system. There is a need for regular training of the people involved. Then comes the fraud or a cyber security risk. Data protection is an important challenge. Cyber threats are very natural today on everyday transaction because of the multiplicity of the digitization and the data points. Implementation of advanced fraud detection system is the need of the hour. There also need to be security audits of the systems and penetration testing to ensure data breach does not happen. Another challenge is that SMEs are not able to get finance. That is because they do not have enough balance sheet strength or a historical pedigree. So there is a need for development of alternative ways of assessing the credit risk of the SMEs. Here, AI and ML could help in scoring, provided they are explainable and acceptable to the parties concerned. So there is a need for partnership between traditional banks and the new fintech companies to ensure SMEs get their share of the financing opportunity in the market. Another challenge is the standardization or lack of uniformity. So the ability to implement APIs between the bank and the corporates and the various legacy systems is also a challenge. So there is a need to invest in technology that will help in integration, for which the prerequisite is standardization or uniform methods. So the trade finance landscape is evolving day by day. The market needs are changing. There is a shift in the global economy. Traditional instruments remain to be important, but new solutions are leveraging the latest technology and addressing certain specific needs. As the industry moves forward, there is room for digitization, room for automation, there is enough scope for sustainability, and then the alternative or a non bank finance is expected to grow. The corporates and the banks are preparing to use data analytics for risk assessment and decision making. And also, there are efforts put in to standardize or make it uniform so that interoperability of the trade finance system is possible. Thanks for watching this video. We shall catch up in another session talking about international trade and the related risks.